Let's get you set for 2023, shall we?
It's wild how big of a difference there is between 2021 versus 2022, right? Us real estate investors started the year with wild 3%-ish mortgage interest rate. And today, it has doubled that.
Not only is the overall increase dramatic, but it happened in such a short period of time, which made the pain so much more severe.
As of November 17, 2022, the weekly average primary mortgage in the US for 30 years fixed interest is 6.6%, up 3.86% from a year ago.
Here's the thing, we don't have a crystal ball to predict exactly what will happen in 2023, but we surely can use economic data principles to forecast what will happen to the economy and specifically the housing market in 2023. Hello, I'm Palmy.
And I'm Nancy. Together we make the Kitti Sisters, your financial BFFs and your apartment investing go-to source. Be sure to stay tuned all the way to the end as we will tell you exactly what the Kitti Sisters 2023 execution plan is to make sure that you win big in the current economic cycle, even when the interest rates are high.
Let's get into it. In recent months, all we've heard is that the Feds are raising their fund rate. It's kind of felt extremely blunt and forceful, and it actually has been disputed by many top economists as being too heavy-handed.
Many have accused Federal Reserve Chairman Jerome Powell of using an outdated playbook from the 70s and the 80s.
Amongst all the criticism, Powell hasn't exactly done a lot to calm our minds. In recent interviews, he's actually stated as saying that in his quest to battle inflation, we need to keep it up until the job is done. Whatever that means, right?
Whatever that means, for sure.
We get it. He stated he wants to get inflation back to 2%, but his tactic has left a lot of doubt. Not only that, but it can be a little bit hard to quantify, right? Whatever he's saying is that he needs a soft landing on prices and he needs them done and drop fast to temper inflation.
The problem is the Consumer Price Index, or the CPI, is considered a lagging indicator, which just means that we won't see the result for up to 16 months. That's a long time to turn around an economy.
What this is all setting us for is an overcorrection, which nobody wants.
Since June, the Fed has raised their fund rate a whopping 6 times. First at 25 and 50 basis points in March and May of 2022, followed by 4 consecutive 75 basis point increase from June to November of 2022.
Inflation remains pretty constant, hovering close to 10%. If you take an even closer look, you can see that from June to September, inflation really didn't drop at all. In fact, it spiked up even higher, touching 9% in July.
With an overcorrection almost guaranteed, most economists believe that the Fed will continue to raise the Fed fund rate at least throughout the December, if not into the Q1 of 2023.
Again, as of November 17, 2022, the average 30-year fixed rate mortgage hovered close to 7%. According to the economists at the Mortgage Banker Association, they predict that this can't and won't last forever. In fact, they think that unemployment will rise in 2023, but that by this time next year, the mortgage rate will have fallen down to 5.4%.
So what does this mean for you all, right? Well, it can mean a lot of things, but the Mortgage Banker Associations also predict that market turbulence and the possibility of a recession will cause a slowdown in demand, leveling out the playing field and causing housing prices to finally become more affordable.
Essentially, economists are predicting that 2024-2025 will see lower mortgage rates, helping boost somewhat of the demand in the housing market.
The good news is in all of this is that if there's a recession, which certainly seems like if we aren't already in one, that it seems that it will be short-lived, and economists are pretty optimistic about the long-term consequences.
So yes, on the flip side, there are some prominent experts out there predicting troubling times ahead for the real estate investors. They believe that rising interest rates will slam brakes on the real estate purchases and or force the sellers to sell properties at a discount, killing cash flow, etc.
We don't fully agree with this line of thinking entirely, but we want to extend this line of thought further. Yes, most unsophisticated investor will camp out on the sideline, and yes, some seller will be forced to sell a property at a discount. However, we believe savvy investor can take advantage of both and make out big.
Interest rate may be a boogeyman and scary thing for some people, but not for us. We're always looking for ways to turn a market condition into our favor.
Let's face it, like most recent investors, we've been spoiled rotten with all-time low interest rate of 2 to 3%, which previously were unheard of. You might be thinking, what's now? How do you really implement and execute after we just rattle a tons of data and statistics at you? Well, now that we got you all excited and believing that now is the time to invest, we would love to share the Kitti Sister 2023 execution plan.
The first step is going to be buying great assets.
For us, this goes without saying, we don't buy old clunky asset that will supply us with unaccounted for deferred maintenance. We are no longer in the era of buying value-add assets and forcing appreciation on it. This is not the ugly duckling fairy tale. Your C-class property, like that hairy one, will not all of a sudden turn to gorgeous swan. It will stay old and hairy and undesirable, right? So lose that fairy tale and buy awesome asset.
For us, we define awesome assets as A and B class assets in A class markets. That's above average population, rent, and economic growth. It goes without saying that this area must be landlord and business friendly. It should also be high median household income, think 80K or above.
The second step in our recipe for success is lining up good debt.
Wait a second, aren't debt a bad thing? Not necessarily. The definition of good debt will vary from investor to investor and time to time. So let's break down what we think is a good debt in 2023.
Well, in this type of high interest rate environment, the best strategy to counter is two-word: loan assumption, which allows a buyer to take on original loan balance at the original term from the seller, right? And of course, loan assumption would only make sense if it's at a lower fixed interest rate right now. For us, it is the most attractive and safest debt options available right now.
We all remember the good old days of 2020, 2021 when we rejoiced at sub 2 to 3% interest rate. Well, with loan assumptions, we can relive those glory days.
Yes, the caveat here is that not all loans are assumable and not all buyers will be able to assume the loan. Typically, Fannie Mae loans with at least 5 years left in the loans or HUD loans are the two available options, right, Palm? Mm-hmm. Right? And then luckily for our investor, Team Kitti's sister, we have experience with both types of loans assumptions.
At this point, some of you may be wondering, hey, what about the new fixed rate agency debt, aka loan from Freddie Mac or Fannie Mae?
We see these two debts as less desirable in two ways. First, you're securing a fixed rate when it's quite high. Historically, US interest rate hikes do not last more than 4 years. So once you're locked down into that high interest rate, unless you're able to refinance, you're stuck paying not so fun rate, which will impact your overall cash flow.
Another area that the GP teams tend to gloss over during their webinar presentation is the yield maintenance, aka prepayment penalties on these loans. At the current high interest rate, it's going to be very significant. Think about millions of dollars. The third step here is to buy cash flowing assets.
We don't know about you, but there's something pretty magical about how that sounds, right? It's like a flowing river of wealth.
You'll notice that the biggest difference between the stock market and multifamily part investing is that one is income producing while the others are just sets of digits on the screen, unrealized until you sell your stocks.
Income producing assets ensure that the property is in a good health and that its growth and projected return are not just based on speculation that no one could actually pinpoint. We always buy property that are cash flow positive from day one. That ensure that we start off on a really solid base and that the growth of the property can only trend upwards from there. Of course, guys, if you buy property that is bleeding cash from day one, there's no certainty of what or how long it would actually stop bleeding. When it comes to your financial freedom, that's too risky for us to take on.
Fourth, make it simple, effective business plan. That's kind of a no-brainer, right? But you should always know that apartment syndication starts off with a business plan based on historical assumptions. There's research, obviously, on in-depth market knowledge and other data points. The goal here is to hit X returns in Y years, and all these items are obviously theoretical until we actually take over the property.
Fifth, select recession resilient market.
Invest in markets that have maintained single digits unemployment. This is a factor that some investors may not have paid too close of attention to, but it's important to select markets where job opportunities are flourishing because well-paid resident will also be your well-paid residents as well.
I so agree with you, Palm. 6 is invest in market with housing shortages.
This strategy follows the tried and true economic principle where low supply and high demand equals pricing going up on your rental properties. Make sure to select market that has strong, well-paying population growth where the housing supply is outstripped by demand.
7, mitigate the risk. All right, let's talk about risk. The truth is, there will always be risk with any type of investing, no matter how turbulent or smooth the economy is operating.
But the Kitti sisters take a very precautious approach to mitigate risk so that our investors can feel comfortable and secure in any investment that they do with us. We start by diving deep into all the data,
Yes, right? So we find out basically every single thing about the property, right? From the market info to the property details and beyond.
It's a lot of energy spent on analyzing report and researching, but guys, it's so worth it.
The more data we know and we understand, the less risk is involved and the more money we make.
This upfront legwork makes it possible for our passive investors to sail through the investment detail with ease and confidence. Honestly, that's the most important thing right now, especially as we're facing high interest rates, inflation, and rocky economic forecasts.
So true. And just to let you guys know, I mean, with the right plan, prep, research, and team, it's absolutely possible to grow your wealth and income in 2023. We are doing it and you can too.
That's why you know now is the time. Thank you so much for tuning all the way to the end. We love you and we would never be able to be where we're at without you.
If you want to hear more about economy, real estate investing, apartment syndication, inflation, and more, make sure to join the Kitti Freedom Club, a passive investor club for everyday people like you to get all the goodies. Until next time, cash flow multipliers.
And of course, don't forget to click like, subscribe, and hit the bell icon so you don't miss any of our videos.